So we covered today, we kind of talked about, for the first three sessions, the overall objective of auditing, what the auditor's responsibilities are with respect to ethics, the professional code of conduct, independence, and just really what the audit means to the capital markets, why it's important. So going forward, what we're going to now start to talk about, keeping that foundation in mind, is the audit process. What exactly do we do when we audit? What's the key information that we need? What kind of evidence is appropriate evidence? What's sufficient evidence? What are we trying to do as auditors with respect to satisfying users of the financial statements that there's integrity with respect to the information that management is putting out there? So we're going to start to really delve into the types of things that we encounter in the audit process. And so starting with that, we talk about keeping in mind what is the purpose of an audit. And the purpose of an audit is to provide those users of the financial statements with an opinion by the auditor. That's what the auditor is expressing, an opinion, because again, the financial statements are prepared by management on whether or not those statements are presented fairly in all material aspects. So next week we're going to talk about what we mean exactly by this concept of materiality and why that's important. And then in accordance with applicable accounting, financial accounting framework, which we know to be GAAP. Right? So the financial statements have to be fairly presented, free of material misstatements, and in accordance with generally accepted accounting principles. The overarching concept is fairness. Right? Fairness to those who use those financial statements and rely on the financial statements. In the auditor's approach to auditing, they have to develop an audit plan. So they have to be able to set forth what are the objectives of the audit. So this is directly from your textbook, and let me just take a step back. I sent out an email, the textbook is available. They said that they ordered enough to satisfy the requirements for both this section and the section that meets on Tuesday. I don't know, so if you want to make sure you get over there and get your textbook, but it is available. Okay, so there are no more chapters that are going to be online. I think Chapter 8 was the last chapter, and we will be starting on Chapter 9 next week. So make sure that you have the textbook, as well as the fact that you start working on your group case. Okay, so back to the audit objectives. So what the auditor has to do in determining what the objectives are of the audit is understand what the objectives are. So we know we're going to be working here mostly with financial statements or audit reports dealing with financial statements and internal controls, but there are other types of audits. Also, an auditor has to understand what's the intended audience for the audit report. How would the client be using the audit report? So clearly, if it's a publicly held company, they have to file statements with the SEC. So you know that the audit report is going to go in their annual filing. But also, companies borrow money from banks. A company could be having a public offering where they're issuing stock, and the financial statements might be used in conjunction with that. So it's important to understand that. And the reason for that, and we'll talk about this more next week when we talk about audit risk, is because that impacts the auditor's risk. Right? The more people who rely on those financial statements, or the more people who are going to use those financial statements, increases risk, right? So the auditors, it's important to understand what the objectives are of the audit, also what the responsibilities are. While management understands that it's their responsibility to issue the financial statement, auditors want to make that clear. And we see these types of identification of responsibilities outlined in the engagement letter. The other thing the auditor is going to do is understand the company's business and how they're going to divide the financial statements. So the financial statements are always going to be divided into cycles. Right? So we're going to talk a little later about assertions And management makes assertions about the information that's contained in the financial statement. And those assertions are made for each transaction cycle. And so a transaction cycle would be, for example, the sales process or the sales cycle, revenue cycle, right? So all of the transactions and all of the accounts that are included in the revenue cycle. So, for example, the revenue cycle includes the company's process of generating revenue. So you know that you're going to have customers, so you're going to have a customer master file, you're going to have accounts receivable, you know, cash is going to be involved in that. Accounts receivable, I said sales returns and allowances, allowance for doubtful accounts. So the auditor divides the financial statements into cycles because that makes the audit approach more manageable. Okay, and it puts some structure around the audit approach. So they divide the financial statements into cycles. It also helps them to understand where the risk is in various cycles, because not all companies have every single cycle. So a consumer products company, a service company is not going to have a manufacturing cycle, right? They're not going to have inventory. An accounting firm, a significant item on their balance sheet won't be inventory, right? Because they're not making anything. Consulting firm, they're not making anything. They're selling a service. So that's also important, too, for auditors to be able to identify where the significant accounts in their financial statements. Know what management assertions are being made about the financial statements, and we'll talk about this a little later in more detail. But this in part goes to the auditor has to be able to rely on management, right? Not to say that they're going to trust them implicitly and not audit, but they have to know that they're starting with financial statements that management asserts are in accordance with GAAP. And so management makes assertions about the financial statements, and auditors develop their audit objectives around those assertions. And that's what we mean by general audit objectives for the classes of transactions, the accounts, and disclosures. And I'm going to defer that because we'll talk about that more, these last 2 points in more detail as we go forward. So responsibilities. Management's responsible for the financial statements and for internal control. The internal control environment is the responsibility of management. They know under Sarbanes-Oxley that they have to establish an effective system of internal control. They understand that they have to produce financial statements in accordance with GAAP. After Sarbanes-Oxley and all of the failures leading up to it, the CEO and CFO now have to sign off or certify both their quarterly and their annual financial statements. This is something that's new since Sarbanes-Oxley. Auditors are responsible for auditing those financial statements. And in relation to that, what they're doing is they are looking at material versus immaterial misstatements. And as I pointed out, next week we'll talk more about this concept of materiality. But for now, materiality is important because an auditor is not going to qualify or give a adverse opinion because the client forgot to book $100 of inventory. For some clients, they will qualify because the client forgot to book 100,000 or $1 million. And that's where materiality comes in at. So depending on the company, depending on the size of the company, depending on qualitative factors, it might not be material. So auditors aren't responsible to find every single little item. And even if they find an item, if it's not considered material, then it's not an issue. Okay? So we'll talk more about that going forward. But remember, when we talked about what the objective is, we talked about material, that the financial statements are free of material misstatements. Reasonable assurance. What does that mean? Why does the auditor provide reasonable assurance? What do we mean by that? What's meant by that? Right. It's impossible. Why is it impossible for them to find everything? Yeah, it's hard to find. Right, it's hard if it's intentional. What else? Right, they don't have enough time to find every detail. What else? Right. What else? Yeah, information's being updated constantly, but also we can't look at 100% of the items. So unless you can say that you look at 100% of the items, every single transaction that that company engaged in the reporting period, you can't give absolute assurance. If fraud, even if you could look at 100% of the items, and management has sufficiently and effectively hidden fraud, fraudulent activity, you're not going to find it. You could have the best audit procedures in the world, and you still might not be able to detect a fraud, uncover a fraud. So you can't give absolute assurance. That's why you give reasonable assurance. And reasonable assurance is driven by the standards, generally accepted auditing standards, is guidance. The minimum standards, if auditors adhere to the minimum standards, provide professional skepticism, independence, that all ties into them giving reasonable assurance. That because they've done an audit in accordance with generally accepted auditing standards, they've shown due professional care, they critically assessed the evidence that was presented to them. And if they've done all of that, they can say, well, we provide reasonable assurance. We did the best we could with the information that we have, and we still weren't able to uncover an error or a fraud, but we did do an effective audit. Errors versus fraud. Frauds are intentional. Errors are just that, accidents, oversight, but a fraud is intentional. But auditors have the responsibility to perform their audit procedures, design their audit procedures, so that if there is fraud or an error, that they increase the likelihood that they'll find it. So they have to develop their audit procedures based on a thorough understanding of the client and the client's environment. And we'll talk more about that when we talk about understanding audit planning and the steps that an auditor goes through to ensure that they understand their client's business. And then we talked about this quite a bit over the last couple of class periods, professional skepticism. So the auditor always has to bring to mind, or to an audit, professional skepticism. No matter how well they know their client, they have to evaluate evidence skeptically. Not assume that the client is dishonest, but don't assume just because, you like the client and they haven't, you haven't found any errors in the past, doesn't mean that there's none out there. So you always have to approach it with a skeptical attitude. So we already talked about reasonable assurance. By providing reasonable assurance, the financial statement users should have a high confidence in the audit. And that's important. I think we saw this when we talked about independence a couple of class periods ago. And one of the examples was a banker who was contemplating extending a loan to a company. And because there was a financial relationship between the audit partner's wife and the company, it gave that banker pause. So they weren't as confident about the information, and we saw what happened. We talked about what their alternatives were, and several people suggested that they would either not extend the loan, so in that case the company loses out on being able to gain financing, which they probably need, or they would extend the loan at much tougher terms. So, for example, high interest rates. We talked about why it's not an absolute level of insurance. So as a result of that, and we talked about this when we talked about risk, there is some risk in the financial statements that there is a material misstatement. But what we're going to talk about as we go through this class is all of the steps that the auditor takes to try to reduce this risk of material misstatement, and that's their audit risk. And we're also going to cover what we mean by sufficient and appropriate evidence. What does that mean? To be able to say that they've tested management's assertions, and they can provide reasonable assurance that there is not a material misstatement in the financial statement. I talked about management assertion, and let me start this discussion by saying management assertions are extremely important. You want to make sure you understand management assertions, because as you will see, from these management assertions, auditors develop their audit objectives. From their audit objectives, they develop their audit procedures. From their audit procedures, they collect evidence, and based on that evidence, they form an opinion. And that opinion accompanies the financial statements in the form of the auditor's opinion, included in public filings and included on companies' websites if they have that, included in the company's annual report. So it's extremely important to understand management assertion. We're going to go through a couple of exercises as we talk about it, but I find that this assertion, the audit risk model, and materiality gives students fits. So maybe you'll be different, but just as an FYI, let's not move past this. If you don't get it, you need to let me know right away. We need to revisit it until it is very clear to you, okay? Because it is the basis of the auditor's approach. So, what are assertions? They're directly related to generally accepted accounting principles, and it's the criteria that management uses to record and disclose accounting information in the financial statement. So the assertions are built around GAAP. Management makes assertions about classes of transactions and events that have occurred to that period. So think about the types of transactions that flow through the income statement. That's considered transactions. Okay? Sales happen the same way all the time. Different customer, maybe different payment terms, but the bottom line is the process of recording a sale is going to be the same for every single customer. The process of recording an expense is going to be the same. A tax disbursement is going to be the same, right? So we consider those transactions, right? Those are transactions that appear in the company's financial statement. So if you sell to a customer, you're going to debit accounts receivable and credit revenue. So it has both an income statement and a balance sheet impact. The other thing, and that's going to be the impact all the time for a sale. The other thing that the client makes assertions or management makes assertions about is account balances. And those are the balances, the ending balances in the financial statement. So, for example, related to the sales process, accounts receivable, allowance for doubtful accounts, cash. So management makes assertions about those. And they make assertions about presentation and disclosure, how the information is presented in the financial statement. So, for example, management makes an assertion that the amount that's reflected in accounts receivable reflects balances unpaid by customers for whom they have sold goods to. So unpaid balances. It does not include receivables from executives. It does not include interest receivable. It includes trade accounts receivable. So that's the presentation on the financial statements, right? Because we know that when we pick up a financial statement and we see accounts receivable, regardless of the company that we're looking at, accounts receivable means open account balances from sales to trade customers. We know that because GAAP says that's what's in accounts receivable. Management also makes assertions about disclosures. So the disclosure that accompanies the accounts receivable, for example, or disclosure about pensions, disclosures about lawsuits. Management's going to make assertions that those disclosures are reflective of business transactions related to the company, and that they're fairly presented, that they're inclusive of the information that should be reflected in the financial statement. The auditor then obtains a combination of these assurances by auditing classes of transactions and ending balances in the account, and including presentation and disclosure. So again, auditors are going to use these assertions that management makes to say, that's my starting point, the financial statements, and the assertions that the management makes about the financial statements, and from there I'm going to develop my audit approach. And that's what we call the auditor's transaction-related audit objectives. So they're closely related to management assertions. It's a framework by which the auditors accumulate evidence. And while these objectives, while the transaction cycles might change, the objectives never vary. The evidence we collect will vary depending on the circumstances for each audit, because obviously if it's if it's a service company versus a manufacturing company, the kinds of evidence you would collect would be different. A company's, the sophistication or of a company's information environment would generate different types of evidence. So the type of evidence will vary, but the objective does not vary. So overall, the auditor is gearing toward getting appropriate and sufficient audit evidence to support management's assertions. So let's take a look at an example or summary of the various assertions. So when you're thinking about assertions, you have to think about one. First of all, what's the transaction cycle? Is it revenue? Is it expenditure? Is it inventory or conversion cycle? And so what am I making assertions about? Because you want to be able to identify the transaction cycle, because that's the way you're going to identify what accounts are in the transaction cycle. Right. Then you want to say, okay, now that I've identified the transaction cycle, what type of assertions? What's the category of assertions that I'm making? Is it assertions about transactions, or is it assertions about account balances, or assertions about presentation and disclosure? And once you identify the category of assertions, then you identify what you're making an assertion about. So let's start with the management assertions about classes of transactions. So again, classes of transactions would be things such as sales. Right? The first assertion is occurrence. And here what what management is asserting is that for the amounts, the sales transactions that I have recorded in my financial statements, they actually occurred. They are valid sales transactions. That's what management is asserting. Auditors, the objective for the auditor then is to ensure that those recorded transactions exist, that they did indeed happen. That's the audit objective. So, a specific transaction related audit objective for sales then would be recorded sales are for shipments made to non-fictitious customers. Right? Why is it why shipping? Why would an auditor's objective be shipping? What about shipping related to sales? Exactly, right? So what the auditor is concerned with here is the earnings process is complete. The only time a sale should be recorded is when the earnings process is complete. And so that's why an auditor related to the occurrence audit objective and assertion is going to look at shipments. So that's occurrence. Management asserts that for everything that's in my financial statement, it actually happened. It's real. The next is completeness. completeness says, okay, so for all transactions that should be in the all transactions that should be in the financial statements are reflected in the financial statements. That's what the completeness assertion says. Management asserts that I've recorded everything that should be recorded. So completeness, the audit objective, again, the auditors are going to look at existing transactions are recorded. That's the audit objective. So for example, sales would say existing sales transactions have been recorded. So what an auditor is going to look at is, okay, I know that it occurred. Now I want to make sure that it is recorded. So they're going to, and we'll look at some audit procedures, they're going to select a different type of audit procedure to test whether or not it occurred versus whether or not, for those that have occurred, that they have been included in the financial statement. So we'll look at two different audit procedures. Other three assertions related to classes of transactions are accuracy, classification, and cutoff. So for accuracy, the auditor has two objectives: accuracy and posting and summarization. Accuracy, the assertion that management makes is that the transaction is recorded at the correct amount. The auditor's objective related to that assertion is that it is recorded at the right amount and it's captured in and summarized in the financial records correctly. So that, for example, if I'm recording a sales transaction, it could be recorded at the correct amount, which is what management is asserting, but I also want to make sure that it's posted in the sales master file and not in the accounts payable master file. So it's not enough for it to be the right amount, it has to be posted and summarized properly. Classification, management asserts that the transactions are recorded in the appropriate account. Auditors are going to test that they're properly classified. So, for example, trade accounts receivable is posted in accounts receivable. It's not posted in interest receivable. It's not posted in employees receivable. So it's classified properly. And cutoff relates to transactions being recorded in the proper period. It's cut off. Management makes an assertion that they've only recorded transactions related to the reporting period. Auditors are going to test and make sure that those transactions are recorded on the correct date. So, for example, if shipping is what determines that the earning process is complete, as an auditor, the test that you're going to perform is to make sure that you select a sample of shipping documents and look at the dates on those shipping documents to determine whether or not they were shipped prior to year end. So those are the 5 management assertions and 6 audit objectives related to sales transactions or the transaction assertions. Then there are account balances. And there are 4 assertions dealing with account balances, one being existing. So basically, assets, liabilities, and equity interests exist. Not different, right? Did it occur in transactions we saw occur? So that was our way of testing whether or not this is really a real transaction. Here with existence, that we do have accounts receivable. Right? We're testing that this wasn't paid off and we didn't record the payment. It's still a valid accounts receivable as of the reporting period. The audit-related objective would be accounts included in the financial statements exist. So things you'd see the auditor do, for example, related to that specific audit objective, is that accounts receivable on the aged trial balance exists. So you're going to go back to the aged trial balance and make sure that that aged trial balance, the amounts that are included in the aged trial balance, are valid. Right? So something the auditor could do would confirm the balances. That's how you confirm whether or not it exists. Completeness, that all assets, liabilities, and equity interests have been recorded. and existing amounts are included. So again, similar to transaction cycle, you want to ensure that you have reflected for all of the transactions balances that they are actually complete. It includes everything that should be there, so that your accounts receivable is not overstated or understated. It's not understated. Valuation and allocation. So related to valuation and allocation, the auditor has five transaction-related audit objectives, and general balance-related audit objectives: accuracy, classification, cutoff, detailed tie-in, and realizable value. So accuracy is that they're stated at the correct amount. Classifications are they are properly classified in the right accounts. Cutoff is that they're recorded in the proper period. Detailed tie-in means that the general ledger account balances agree with the master file account balances. So you can tie or reconcile what's in your accounts receivable age trial balance to the amount that's reflected in the general ledger. Because remember, the general ledger is what rolls up to your financial statement. And then the realizable value, the assets are included at its estimated realizable value. So think about the accounts that we have on the balance sheet that require net realizable value. What are those accounts besides accounts receivable? And how do you reflect the net realizable value in the financial statements? How do you reflect net realizable value for accounts receivable? How do we show it in the financial statements? I know you took financial accounting not that long ago. Throw it out there. Less allowance for doubtful accounts. What do we mean by net realizable value? Why don't I start there? Yes. Do you have your name tag, Captain? What's your name? Charlie? I can't hear you. Chung. Okay, there you go. Speak up, Chung. Okay. So net realizable value. Right. It's a management's estimate of what they will actually collect. So we have an allowance for doubtful accounts because that tells us realistically you're not going to collect 100% of your accounts, or there's a high probability that you won't collect 100% of your accounts receivable. So you have to show that. What other accounts do we show at a net realizable value on the financial statement? What other asset accounts? Inventory, right? Yep. Because inventory we show net of what? We had this problem. We did this last week. Right, obsolescence reserve, right? So we show net of obsolescence reserve. What's another account that we didn't cover but you should know? This building is what? Fixed assets, right? And we show it net of, right. So that's it. That's what this is saying in terms of the evaluation and our allocation. Is GAAP tells us there are certain things that we have to show at net realizable value, and the financial statements have to reflect that. Then rights and obligations is simply saying that the assets and liabilities and equity on the business, on the company's financial statements would belong to them. So some companies might factor, for example, accounts receivable. If you factor the accounts receivable, you're basically selling your accounts receivable because you need the money. So it's a way of financing. So if you sell those accounts receivable, they're not yours anymore. You can't double dip, right? You can't show that you have this inflow of cash and still have this asset called accounts receivable. It's not yours anymore. So you no longer have rights to it. You have to disclose that in the financial statements. You have to reflect that in your financial statements. So that's what we mean by rights and obligations. So an auditor is going to make sure that the balances, that the client has the right to those accounts that are in their financial statements, or those assets that liabilities are their liabilities. You should not reflect, as a company, the liabilities for your officers. That's not a liability of the company. So management assertions about account balances, and then finally management assertions about presentation and disclosure. So occurrence, rights, and obligations, completeness, accuracy and valuation, classification, and understandability are the four. So disclosed events and transactions have occurred. All the ones that have occurred are properly reflected in the financial statements. They're appropriately disclosed at appropriate amounts in the financial statement. Financial and other information is appropriately presented and described and disclosed as clearly expressed. Okay? And then the auditor's general audit objectives are going to follow those. So examples would be, for example, occurrence, rights, and obligations, that accounts receivable as described in the footnotes exist in the right and are the rights of the company, or required disclosures related to accounts receivable included in the financial statement footnotes. Footnote disclosures related to accounts receivable are accurate. Accounts receivable appropriately classified. And short-term and related financial disclosures are understandable. So that's just, again, the audit objectives are going to match what the client's assertions are. So let's take a look at a problem. So turn to your text, your problem 629. And let's take a look at this problem. 629. And if you don't, well, I have the problem here, but the auditor obtains a list of accounts payable, which equals the accounts payable balance in the general ledger. With respect to that, they're making two balance-related audit objectives. So because we're talking about accounts payable is a balance, an account on the balance sheet. So it's a balance-related audit objective. They make this assertion that management has made this assertion that all accounts payable included on the list represents amounts due to valid vendors, and two, there are no unrecorded accounts payable. So given that information, take a few minutes and think about these three questions, and then let's talk about it together. What's the difference? Which of these two applies to existence and which applies to completeness? And then which one would be the most important considering accounts payable? Okay. So what is objective one concerned with? Well, they're both assertions being made about accounts payable. Yes, Mike. Why occurrence? So, any other thoughts? Why? Why do you say existence versus occurrence?
Because number one, sales transactions deals with occurrence versus existence of how account balance.
Right.
Because occurrence, in order for a sales transaction, it involves an action that needs to happen. That's how something occurs per se. But in order for something to exist, it has to be there physically, so you can do it.
Right. So do you remember what I told you beginning? First, identify what category of assertions are you talking about, because your description, your reasoning was right, but it wasn't the right assertion, right? Because you were in the wrong category, right? So that's why it's really important, because obviously there's some overlap here, right? So it's important to first identify obviously what cycle you're in, but I already told you that, right? Because I told you it's accounts payable. But then identify what's the category of the assertion, and once you identify the category of assertion, then you're better able to identify what assertion. Mike was right on about what it was trying to do. It was just that he was not in the right category. Okay. So existence is correct. What about number two? Completeness, right? Why? Why do you think completeness? It is completeness. Right. You're looking for no unrecorded liability. So that's telling you that you want to make sure that everything that should be recorded has been recorded. If you tell me it's a liability, that means that I've incurred this expense. So I want to make sure, the auditor wants to make sure that it's been reflected. So which of these, what are we trying to do by it? What's our concern as an auditor with respect to the existence of accounts payable? What are we concerned with? The impact. Yes. Well, possibly. But be a little bit more specific, because it might not be fraud, it could be an error. We're concerned with frauds and errors, but what does exist? What are we trying to make sure hasn't happened with existence, Natasha? Right, you're concerned about overstatement, right? Right, which would be overstatement of accounts payable, right? And what about the second one? There are no unrecorded. Then you're concerned about understatement, right? So the first one says, I want to make sure that only valid accounts payable are there. I don't want the company to overstate accounts payable. And the second says, I want to make sure that for all valid liabilities, they've been reflected in the financial statements so that there are no understatements of accounts payable. Given that, what's your biggest concern with respect to accounts payable? What's, of those two, which is a bigger concern to the auditor? Understatement. Anyone else? I think I heard an overstatement. Why? Okay, so, what's your name?
You call me DJ.
DJ?
Yeah, my first name's Ben.
DJ, okay, I can remember that. DJ, why do you say understatement?
Because essentially, if you understate your accounts payable, which is a liability, it'll help overstate your income. And essentially, fraud is pure sense.
Or
that also conflates investments, which your income is higher, yes, higher, things like that. So it's your reaction to people's investment. Versus if you understate your net income, very to do a tracker statement or like make a amendment return or something like that, and then say, oh, my net income's even higher.
Right.
So I think it'll be more.
Right. Exactly. Because it's the impact on your income statement resulting from an understatement of accounts payable is you've increased your net income. And net income matters to the market, right? You always see EPS, right? You always, and what is EPS based on? right? A component of that is net income, right? So it is going to have more, it's less conservative, right? Whereas an overstatement is more conservative. Not that it's right. So yes, auditors are concerned about both, because both would result in errors. It's the impact of the understatement that has probably a more negative impact on the market. Are you convinced? You're giving me that, well, maybe. Look. Well, yeah, they're both. Yeah, it's important. Both of them are important. So I'm not implying that it's okay to overstate accounts payable. That's not what I'm saying. What I was trying to get at is the impact that it would have on net income. And a understatement is going to make net income look bigger, right? Bigger than it really is. And so because the market, you have so much, as DJ indicated, that drives from that net income, that's based on that net income, you're sending a much more negative message than if there is an overstatement. Because an overstatement is your net income is a lot lower, or it's lower, right? And so you would, if the market was going to penalize you, they already penalized you. So it's not that it's not important, but it's just that with respect to accounts payable, you're more concerned about understatements. And especially if you have concerns that management might be trying to manage earnings. They're not, if they're trying to manage earnings upward, then they're going to be looking for ways to increase net income, and that would be, if they try to do it through accounts payable, or the expenditure cycle would be by looking for ways to reduce expenses and increase net income. Okay. Any questions on this one before we move on?